Hi students, my name is Reji Vinod. Welcome to Sri Pavitra Academy online classes. Today I am going to explain GST accounting. It is in 11th class and CA Foundation accounting subject and it is part of journal entries. So GST is a wider subject. I am not going to explain the total subject, but for what is relevant for the journal entries I am going to explain. So GST is a destination based consumption tax, means tax is levied at the place where the goods and services are consumed. Simply we can say who is buying the goods, they have to pay tax. That is, the end user of the goods should pay GST. For example, if I purchase one computer for my personal use, I should pay tax, and the revenue, such tax revenue goes to the state where the goods or services are consumed. For example, if I am staying in Kerala and I am purchasing a computer and paying tax, the revenue goes to Kerala. So that is called GST, is a destination based consumption tax, and GST is an indirect tax. As I already told that GST is a destination based consumption tax. So if I purchase something, I should pay tax, but here I am paying GST to the seller of the goods. The seller will pay the tax collected from me to the government. So even if I am paying tax, the liability to pay tax to government is with the seller. So simply we can say the liability to pay tax to the government is on one person, that is manufacturer or seller or service provider, but the same is collected from buyer. That is called indirect tax. So I am paying tax indirectly to the government. I am paying tax to the seller, and the seller is paying tax to government. So in this case I am paying tax to government indirectly. That is called, it is an indirect tax. And GST is levied on supply of goods or services. Here in GST, supply is the taxable event. Supply means either manufacture or sale or services, etc. Supply creates liability to pay tax. That is, if there is a supply, the liability to pay tax arises. This is example of one invoice in GST. Here you can see the seller is from UP, Uttar Pradesh, and the buyer is also in UP. So in this invoice there is SGST and CGST. SGST means state goods and service tax, and CGST means central goods and service tax. And in another invoice, the seller is from Maharashtra and the buyer is in Tamil Nadu. Here IGST is applicable, that is integrated goods and service tax. Now I will explain this concept, this type of GST. So in GST there are two types of supply. One is interstate, another one is intrastate, another one is interstate. So what is intrastate sales? Intrastate sales means within the state. Within the state means the buyer and seller are staying within one state. So for intrastate sales there are two types of GSTs, that is CGST and SGST, or CGST and UTGST. So CGST means Central Goods and Service Tax, and CGST is levied and collected by central government. SGST is State Goods and Service Tax, which is collected by state government. UTGST means Union Territory GST. So for intrastate sales, that is the sale is happening within the state, means there are two types of GSTs applicable, CGST or SGST. Means for within a state means CGST or SGST. Within a union territory, CGST or UTGST. This UTGST is applicable for UTs without legislature, means without an assembly. For example, Andaman Nicobar, Lakshadweep, etc. These UTs are directly under the control of central government. But some UTs have separate legislative assemblies such as Delhi, J&K, etc. So for these UTs, SGST is applicable. So if UT is with legislator, SGST is applicable. For UTs without legislator, UTGST is applicable. So for state, CGST and SGST, and for UTs without legislator, CGST and UTGST is applicable. For CGST is levied and collected by central government, and UTGST is SGST or UTGST is collected by state or UT. So in the previous bill, the seller is from UP and buyer is also in UP. So this is within the state, means the two GSTs applicable are SGST and CGST. So within the states, this is called intra-state supply. Next is interstate supply. Interstate supply is nothing but the buyer is from one state and the seller is from another state. That is called interstate. So for interstate supply, there is only IGST is applicable. IGST means integrated goods and service tax. This is levied and collected by central government, and the rate is normally CGST plus SGST, means double. The tax of CGST plus SGST is equal to IGST. So for interstate supply, IGST is applicable. In the previous bill, this seller is from Maharashtra and buyer is from Tamil Nadu. So it is an interstate sales. So in this tax column, it is not written as CGST or SGST, it is IGST. That is the difference between interstate supply and intrastate supply. Next important concept is output and input tax. So I will explain through an example. Suppose there are three people: manufacturer Mr. X, trader Mr. Y, and consumer Mr. Z. So manufacturer sold goods worth 10,000 plus 10% GST to trader, and trader pays 10,000 plus 10% of 10,000, that is 11,000. Total 11,000 to manufacturer X. So here manufacturer X is seller and Y is buyer, and trader sold the same goods worth 10,000 to Z for 12,000, because 2,000 is his profit. So he added 2,000 profit to this goods and add GST 10% to Mr. Z. So Z paid 13,200, that is 12,000 plus 10% of 12,000 is 1,200. So 12,000 plus 1,200 is 13,200. So X sold goods to Y for rupees 11,000. In that 1,000 is GST. Y sold goods to Mr. Z. He is the last consumer, means he is using the goods. So Y sold goods worth 12,000 to Z and collected GST of 1,200. Total amount paid is 13,200. In this case, for Mr. X, that is the original seller, means manufacturer, the GST collected rupees 1,000 is recorded as output tax. So what is output tax? Output tax is nothing but GST charged on supply. So in this case, manufacturer X sold goods to Mr. Y and collected 1,000. So for the manufacturer, it's a liability towards the government, means he has to pay 1,000 rupees to government. So it is called output tax liability. So he should pay the amount to government. And for the trader Y, there are two GST. One GST he paid to Mr. X and another GST he collected from Mr. Z, that is consumer. So this 1,000, that is he paid the tax to Mr. X, that is called input tax. For Mr. Y, it is called input tax, that is GST paid to the seller. So For accounting purpose, it is called input tax credit. So input tax credit of GST paid is 1000, and he already collected 1200 from Mr. Z, the consumer. So it is called output tax. It is his liability towards the government. So output tax is GST charged on supply, that is 1200. So for the trader, there are two types of taxes: input tax, which is he paid, and output tax, which is he collected. So in this case, his liability to pay tax is 1200, but he already paid 1000 to Mr. X, so his net liability is only 200. So input tax credit means the amount paid he can set off against the liability towards the government. So input tax can be set off against output tax. So in this case, amount paid to government is 1200 minus 100, that is 200. And the consumer Z, he don't have any input tax or output tax because he is using the goods. So he is the ultimate taxpayer. He paid 13,200 and 1200 as GST amount. In that, 1000 is paid by X to government, 200 is paid by Y to government. So for government, total tax collected is 1200, 1000 by from manufacturer and 200 paid by trader, but actually the tax is paid by consumer. So this is called indirect tax. He is paying 1200 to government, but indirectly through trader and manufacturer. So the concept of output and input tax is nothing but, in output tax is tax collected from the buyer, and input tax is tax paid to the seller. So for input tax, we can take a set off for output tax. Next, utilization of input tax credit under GST. So if you have an input tax, you cannot set off this tax as you wish. There are some rules. So if you have an IGST input tax credit, because if you paid an IGST amount for interstate supply, the IGST input tax credit can be utilized first against IGST liability. So if you have one IGST liability, you can set off IGST input tax credit against IGST liability. And if there is balance, suppose there is 1000 rupees input tax credit and 800 rupees liability, you can set off that 1000 rupees to 800. So balance 200 is there. That 200 you can use against CGST or SGST liability. So if there is IGST input tax credit, first utilize that IGST input tax credit to IGST liability, and then balance if they are used against CGST or SGST liability. And if you have an CGST input tax credit, so for CGST input tax credit, first utilize the CGST input tax credit against CGST liability, and if there is any balance, you can use only against IGST liability. So CGST cannot be utilized against SGST liability. And SGST input tax credit or UTGST input tax credit, you can use it for set off against SGST liability or UTGST liability, and then only balance if there something, so then only IGST liability. So IGST input tax credit you can use for IGST liability, and balance if there it is used for CGST or SGST. CGST input tax credit if there, first utilized against CGST liability and balance against IGST liability. SGST or UTGST liability, first against SGST liability and balance something is there, so IGST liability. So CGST liability and SGST liability cannot be utilized against SGST or CGST liability respectively. This is the rule of utilization of input tax credit under GST. Next, journal entries. I will explain through one example. Suppose there is manufacturer X. He sold goods worth 10,000 to Mr. Y. CGST 5% collected 500, SGST 5% collected 500. Total price charge is 11,000. 10,000, 500, 500, so total 11,000. In this, 1,000 is output GST, means manufacturer's liability towards the government, that is output GST, CGST 500, SGST 500, total 1,000. So journal entries in the books of Mr. X, means manufacturer's book. How he first is sales, total sale amount is 1,000, CGST liability is 500, SGST liability is 500. So this is output CGST, output SGST. So sale is credit balance, liability is credit balance, and here the buyer is Mr. Y. So it's a receivable. Mr. Y account debit. If he received the amount he already received, means bank account. So either Y account or bank account. If he not yet received the amount, he can write the journal entry as Mr. Y, because it's a receivable for Mr. X, and if he received the amount, means he can write bank account. So total amount is 11,000 he received or receivable. So debit means it's an asset, that's why it's debit. 2. Sales account 10,000. Here sales amount is 10,000. It's credited. Why? Because it's an income. Next is output CGST 500. Why we are crediting this? Because it's a liability towards the government. Next is SGST output. Output SGST 500. That it's also a liability towards the government. So journal entry is Mr. Y account or bank account debit to sales account to output CGST to output SGST. So narration is being sale of goods sold on credit and charged CGST and SGST at 5% each. Next is payment of this tax to government. So output CGST debit. Here liability is credited, while reducing we have to debit. We are paying the amount to government. So output CGST liability reduced, debit 500. Output SGST account debit 500 because liability reduced to bank. Payment made through bank. So bank amount is reduced. Bank is an asset, so asset reduced 1,000. Being CGST and SGST paid to government. So in the books of the seller, that is manufacturer, he is selling the goods. For him it says sales, and amount received means bank, receivable means the debtor's name, that is Y account. So Mr. Y or bank account debit 11,000 to sales account to liabilities, means output as CGST, output as GST, and output CGST and output SGST paid means the CGST account and SGST account debit to bank account. Next, the same sales in the books of Mr. Y. So in the example, he is purchasing goods from Mr. X. How much? 10,000. CGST paid is 500, SGST paid is 500. So total amount paid is 11,000. So for Mr. Y, input tax credit means tax paid to Mr. X is 1,000. So in this case, in the books of Mr. Y as a buyer, means he is buying the goods. So for him it's a purchase, and these two amount means CGST and SGST is input tax credit. It is for Mr. Y. These two accounts are assets. So how he will record that? Purchase account debit. Why? Because it's an expense. Input CGST account debit 500, it's an asset. He can set off this for future. So input CGST is an asset. Debit input SGST account debit 500 to, if the amount is not paid yet, means Mr. X account he can write. If paid means he can write bank account. So either Mr. X account because it's a payable. If paid means bank account. So purchase account debit, input CGST account debit, input SGST account debit to Mr. X or bank account, total 11,000. Being goods purchased from X and CGST, SGST paid at 5% each. Next, the trader a seller, because trader sold goods to Mr. Z, consumer. So sales to consumer is 12,000, because 2,000 he added profit to 10,000 worth goods, so total value is 12,000. And he collected GST, CGST 5% 600, SGST 5% 600. Total price received from Z is 13,200. Here his liability towards the government is actually 1200. CGST plus SGST collected amount is 1200, but his input tax credit is 1000, means 500 for CGST and 500 for SGST, so 1000 he already paid it to Mr. X. So net amount to amount payable to government is only 200. This is the liability of Mr. Y. So in the books of Mr. Y, the same transaction through journal entries. First, total amount receivable is 13,200. So either Mr. Z, if it is receivable, not yet received means it's a receivable, so Mr. Z, if it is received means bank account, either Z or bank. Mr. Z or bank account debit, total amount is 13,200. In that, sales account is 12,000. Output CGST, the liability towards government is 600. Output SGST is 600. So total 1200. Being sale of goods sold and charged CGST and SGST and 5% each. Next journal entry is set of input tax credit against output GST. So output CGST is a liability. In order to set off, we have to debit it. So output CGST debit, output SGST debit to input CGST. Already he recorded the input CGST as an asset, so at the time of set off he has to credit it. Input CGST, input SGST to bank, balance paid to government, that is bank. Output CGST 600, output SGST he collected this amount and he set off input CGST and input SGST, balance paid to bank. So narration is being output GST liability set off against input GST paid and balance paid to government. Next example, Rohit purchased goods from Sam for 40,000 at a trade discount of 10% plus CGST and SGST at 9% each. 20,000 was paid immediately and balance payable after 3 months. In this case, Rohit purchased goods from Mr. Sam. Total amount of purchase is 40,000, but there is a trade discount of 10%. So trade discount means it is part of purchase. So while recording purchase, we have to deduct this trade discount from purchase. So net purchase is 40,000 minus 10%, that is 36,000 only. That is the there are two types of discount, trade and cash. Trade discount always deduct from purchase, but cash discount you cannot deduct from purchase. CGST and SGST is 9%. So in this case, in the books of Rohit, for Rohit it's a purchase, so purchase is an expense, debit. Purchase account, total amount is 40,000 into 90% means 10% minus. So 40,000 into 90% is 36,000, and here at the time of purchase he paid tax, so it is input CGST account 36,000 into 9%, input SGST 36,000 into 9%, 3,240 to Sam's account, and to bank means he paid 20,000 immediately, so to bank 20,000 and payable amount is 22,480, that is 36,000 plus this tax amount 3,240 minus paid amount, so balance payable is 22,480, being goods purchased from Sam, CGST and SGST payable at 9% each. So in this case the trade discount point is important. Why? Because at the time of trade discount you have to deduct that particular trade discount from the purchase and record the net purchase. So purchase account is only 36,000. Suppose in this case it is cash discount, you have to record 40,000 and calculate the tax accordingly, that is 40,000 into 9%. Next example, goods costing 20,000 withdrawn for personal use. Such goods were purchased by paying CGST and SGST 9% each. Suppose in this case, one person, suppose Rohit already purchased 40,000 worth goods, and in that 20,000 worth goods withdrawn for personal use, and such goods were purchased by paying CGST at 9% each. So here end user is the purchaser, so he is not selling the goods again. So the last user is the purchaser, so he cannot avail input tax credit. So if he already recorded input tax credit, he has to cancel it. So in this case, drawings withdrawn for personal use means it's drawings account, that is debit. Total amount is 20,000 plus this is cost, so including GST means 23,600. Purchase he has to cancel. Why? Because purchase reduced the goods he taken to personal use. So purchase account credit 20,000. He has to cancel input CGST and output input SGST. So drawings account debit to purchase account to input CGST account to input SGST account. Being goods purchased for personal use and input tax debited previously reversed. Here input tax reversed. At the time of purchase he debited the input CGST and SGST, and at the time of final use of the goods he reversed the input CGST and input SGST. This is also important point. Next example, sold goods to Manpreet for 1 lakh at a trade discount of 20% and charged IGST. Here IGST is charged, so it is an interstate sale, but the journal entry will be same. Manpreet account means it's a receivable. So total purchase, total selling price is 1 lakh minus trade discount of 20%, so 89,600. Sale is 80,000. 1 lakh into here 80,000 plus 12% IGST 89,600. Sale account is 1 lakh into 80%, 80,000. Output GST, that is liability towards government, is 80,000 into 12%, 9,600. So total amount receivable from Manpreet is 89,600. In that sales account is 80,000. GST liability is 9,600. Being goods sold to Manpreet at trade discount of 20% and IGST collected is 12%. Next is goods of list price 20,000 returned by Manpreet. Out of these goods, 20,000 worth goods returned by. So it is sales return account. List price 20,000 means the gross amount was 20,000. So after deducting discount, the recorded price was 16,000. So sales return is 16,000 debit. Sales credit, so sales return is debit. How it calculated? 20,000 into 80%, 60,000. Next is output IGST. We have to reverse the amount. 16,000 into 12%. Here IGST liability credited. At the time of reversal we have to debit it. Output GST debit 1920 to Manpreet 17,920 means Manpreet's that asset reduced. So here debit, reduced means we have to credit. Total 16,000 plus 1920 we have to credit. So being goods returned by Manpreet. So this is all about GST accounting. Thank you for watching. If you have any doubt, please message me. I will clear it. Thank you.